So I guess we can start. First and foremost, thank you so much for being here. Today is our market call for energy commodities. My name is Victor. It's a pleasure to receive you. The idea today is to discuss about energy commodities, what are the main fundamentals that are affecting the prices of commodities. We're going to talk about region fundamentals, especially United States, where most of the futures of energy are traded. So the idea today is to bring a lot of those insights and a lot of things that are happening right now that can impact the prices on the future. Okay. A brief introduction of myself. My name is Victor. I'm a senior energy and analyst here, energy and macroeconomics analyst here in Hedgepoint. I have been working on technology industry for the past 8 years. Most recently, in the last 3 years, I have moved to the commodities sector, where I have been working for the past 3 years in a refinery here in Hedgepoint. I'm an economist and statistician with specialization in finance and data science. So it's a pleasure to receive you all. If you have any doubt, if you want to talk to me, if you want to discuss any fundamental, any data here, please feel free to reach me out. Here you have my contact, my LinkedIn, and my email. Also, I would like to invite you all to go to the Hedgepoint Hub. It's a very interesting platform where you can find a lot of contents, a lot of things regarding to hedging, regarding to futures, about markets, commodity markets. You can find a lot of update analysis, update reports. So it's a very interesting place where you can find a lot of information. I invite you all to go there and have contact with your contents. Okay. Also, we have your Hedgepoint Academy. It's a very nice place where you can find a lot of information about trading options, commodity tokens. For those who are seeking for knowledge that want to learn more about hedging and other things, it's a very nice place. So I invite you all to go there. And here we have your market call schedules for November. We are almost by the end. Today is energy call. Next week, we're going to have the sugar call and grants calls in 25 and 26 of November. So also, it's very interesting. My colleagues, you present fundamentals for those markets. So I invite you all to go and watch their call as well. It's a very interesting insights that they have as well as we have here for the energy call. Okay. So let's start. Here we have our contents for today, our agenda. We're going to start by one introduction, talking about the macroeconomic fundamentals that are somehow impacting prices in this moment, the energy commodities prices. Then we're going to talk about the market overview, what are the main fundamentals that can affect the prices and what is happening right now in the market. So we have a lot of things to talk about the conflict in Ukraine and Russia. Then we're going to discuss the regional fundamentals, especially United States. How is the stock levels? What is being the driver, prices driver right now on the market? And then one last section, we're going to talk briefly about the biofuels market. That's a very interesting topic that I bring here some ideas and fundamentals that I would like to show you all. Okay, so let's start, and maybe one of the most important messages that we have for this presentation is that dollar has strength once again since the election of Donald Trump, since the victory of Donald Trump United States. And it's very important to watch the price of a dollar on the market because most of the energy commodities, they are traded on dollars. So when dollar becomes more strength, has more strength in the market against other currencies, that means that crude oil and other commodity assets are more expensive for holder of other currencies. So right now, with the strength of dollar, crude oil and other commodities are becoming more expensive for holders of other currencies, and that is one risk that we can have for the demand side of the equation, because prices in the market, it's a balance between supply and demand. And from the demand side, the strength of the dollar can bring some bearish sentiment because with the strength of the dollar, that makes commodities more expensive for holders of other currencies, and that can affect the buying, the purchase of commodities in the market. So Here you can see that most of this strength of the dollar is coming from euro. Euro is the main currency that has most the higher weight on the DXY index. Stronger depreciation from the euro recently, so that is bringing this support for the appreciation of the dollar, and that's something important to pay attention for the coming weeks. Okay. Also, when we look to the US fundamentals, there are some uncertainties that are emerging again in the market. The main one is the treasury yields of the US treasury. And why that is it's an important risk that we should watch on the market. Because we know when the yield curve inversion is happening and it's deepening, there is a huge, there is a higher risk of a recession in the United States. We're not saying, it's not our scenario, our base scenario, that the United States is going to a recession. It's far from that. The economic activity is still very strong in the country. Labor market is still very heated. Employment rate is still very low. So there are no major signs of a recession coming to the United States. But it's important to say, when you are thinking about risks, that when we have this kind of situation happen in the United States, we have to be careful. And that's something that I would like to signal to you all, that the yield curve reversion is happening again, once again. It's not inversion so far, but it's also, again, we have this risk. And when that is happening, and when that deepen, we have some risks of recession, and that's important to pay attention. It's important to observe in the market, okay? Also, when we're thinking about the demand for energy commodities, and just a quick comment in this slide, and why the recession is a significant risk for energy commodities, because we know when we have a recession, there is less demand for energy commodities, and that's why that's something we should watch. But again, it's not our base scenario. I don't believe that the United States is going to a recession environment for the coming year. I'm just mentioning that it's important to pay attention on the data and the signals that the market is bringing, and somehow manage the risk using all this data. So it's I invite you all to talk with our energy team. We have Daniel, we have Team Vincent. They all have a great knowledge about how to hedge operations or how to protect against the risks of the market. So I'm just mentioning that it's important to watch that and using this kind of information to manage the risks that you have in the market right now, okay? Talking about the PMI, and I like to watch this because most of the explanation that we can have why demand this year for energy commodity has not been so strong as expected by the beginning of the year. One of the reasons for that, it's because the PMI manufacturing sector is still, for most of the regions, most of the important regions in the world, below the 50 mark, which means contraction, especially for the United States, Europe. China right now has come above the 50 level, so that's a good sign. That means that maybe China can demand more energy commodities in the future. But most of the important regions like Europe and the United States is still below that level, and that's one of the reasons why demand has been so constrained over 2024. Okay. And now I have a table, just a simple table that is trying to show how has been the sentiment for the energy market so far. So as you can see here in the second table, month of month, most of the commodities has depreciated, especially crude oil, RBOB. When you look year over year, most of the commodities has depreciated also, especially crude oil about 10%, RBOB about more than 7%, heating oil more than 20%. Most of the refined products is a reflection of the lower prices of crude oil. But it's interesting to notice that the price for the main benchmarks for natural gas in United States and Europe has appreciated, significantly appreciated recently. And what explains this movement for Henry Hub and Dutch TTF Dutch benchmarks to appreciate it? Right now, over the last week, we are having an escalating war between Ukraine and Russia. And when we have this kind of escalation that is bringing more risk premiums into the environment of energy commodities, we know that any kind of threat to supply issue in Europe that can affect the flow of natural gas coming from Russia into Europe, it's making prices to react strongly, especially the natural gas prices, because Europe is very dependent of energy, very dependent of energy commodities, especially natural gas. And when we look at this, and given the ability of United States to export natural gas to Europe, we are seeing these prices reacting strongly. So this is the first factor, the geopolitical risk that is coming to the market. The second fundamental that is bringing this more bullish environment for natural gas, it's because the comparison base for Henry Hub and Dutch natural TTF in the previous years, it's for a lower base. So in 2023 was a very bearish environment for natural gas, and right now with the prices reacting, the comparison between 2024 and 2023 makes the percentage appreciation of those benchmarks much stronger in 2024, because the base in 2023 was very low level. So that's the second thing that is happening. Okay, I'm going to talk more about that over the presentation, but the first thing that I would like to call your attention is that we had over the past 60 days a more bearish environment for energy commodities, but right now on this week we are having some developments that is bringing some bullish support for few commodities, and the big winners on this environment, it's natural gas, especially the benchmarks of Henry Hub for United States and Dutch TTF on Europe. Okay, also RBOB, it's having some interesting effect. The WTI crack, it's having some interesting reaction also. So I'm going to talk more about that on United States region fundamentals, but it's important to say that looking to RBOB fundamentals, I have something interesting in my mind that I'd like to share, but I'm going to talk more about that in the next section. Okay, so that's the introduction. We are having some bearish fundamentals coming from the macro front that is putting some weight, putting some constraints on the energy commodities, but at the same time you are having geopolitical risks coming back and bringing some premiums to energy assets. Okay, so here let's focus again on crude oil. And again, why it's important to talk about crude oil, because the price of crude oil has a direct impact on refined products like RBOB, heating oil, and other refined products. And here we can see that the prices of crude oil now are very close to the average of the past 10 years. So this is an important support that we're having right now for the prices of crude oil. And given this, plus the geopolitical risks that we are having right now, we're probably going to see these Brent levels above the $70. We're going to see the WTI above the $70. We have a strong support right now for the crude oil market, given all this context. However, for the coming year, especially after December, January, we have some important decisions on the market that can bring bearish fundamentals for crude oil market. The first one will be the decision of OPEC if they will pump more crude oil into the market, if they will increase the supply, or they will choose to make this increase in supply lately for the coming months. Right now, the tendency, the trend, is that they will again to late this increase of production, because prices have been kind of weak recently because of the decreased prices of crude oil. But the risk of the increase of the supply, it's something to pay attention and can bring prices below these levels that we're seeing right now. But if they don't increase the production right now, given the geopolitical risks, more the technical fundamentals that we're having right now, that the prices are above the verge of the past 10 years, we have room for crude oil keep this tendency to be above the $70 per barrel level. Okay, so that's something important to keep in mind. Important to mention that 1 month ago, 1.5 months ago, we had a very different scenario for the energy commodities. We had prices of crude oil being traded in much higher levels. And most of the reasons why market has been more pessimist about crude oil demand, more bearish about crude oil prices, is because demand in the world has been lower than expected by the beginning of the year. So one of the major reasons why market is watching the crude oil market that way is because imports on China has been very lower in 2024 when compared with 2023. On this chart, we have the imports per month, daily imports per month for 2024, 2023, and the percent variation year over year. And as you can see in the second half of the year, the lower imports of China has been very consistent. And that's one of the reasons why market has, it's believing that consumption for oil in 2024 will be lower than expected by the beginning of the year. Right now, we have a few projections for crude oil consumption. OPEC has almost 2 million barrels per day of projection. The IEA believes that oil consumption right now will be below 1 million barrels. And this diversion of projections on the market, it's also brings some concern because probably someone is very wrong on that equation. OPEC usually is more optimistic about oil consumption. IEA is usually less optimistic about oil consumption, but probably we're gonna have the consumption this year, the expansion consumption of this year, a little bit above 1 million barrels per day. I would say 1,100,000 barrels per day. So let's see how will be the last 2 months of the year. But one thing is very clear: demand, the consumption expanding demand for this year has been lower than expected. And when we look into China, has been almost the imports 500,000 barrels lower per day than it was in 2024, in 2023. Okay. And all this situation, all these fundamentals has developed this more bearish environment for crude oil. Speculators are a little longer for oil right now, given the past weeks we had this two things. The first is because the prices has dropped significantly. So over this level, we have support. So they are a little bit more longer for oil right now. And also with the recent developments in Russia and Ukraine, you bring support, a geopolitical premium to the market and bring support to crude oil prices. So today we have the release of CFTC and NICE long and short positions of no commercial players. And I believe for the coming weeks, we're going to have some increase on these longer positions, given all the last developments that we're having right now in the market. Okay. So this is the market overview. We still have bearish fundamentals coming from the demand side, but prices has retreated significantly. So we have some support right now. And with the geopolitical risks development in Ukraine and Russia, it's bringing even more support for crude oil on this moment. So that's something to keep in mind. So after the introduction and the market overview, let's discuss about the region fundamentals. So here I'm going to cover data regarding the United States, Europe, Asia, OPEC, and then we can try to figure out what's happened on the different regions and how that can affect the prices, okay? First thing important to mention here that the crude oil commercial stocks in the United States is still in a very low level. We are having an increase on the total crude oil inventories in the United States when you have the strategic petroleum reserves plus the commercial oil stocks. But when we look just over the crude oil commercial stocks in the United States, we are in a very low level, below the level that we saw in the past years. So that is bringing some support to the market as well. But however, it's important to mention that when I look through this table, and I ask sorry to you guys here, this is a small mistake. This is oil production of the United States. When I look at this, it's interesting to notice that the exports of crude oil in the United States are decreasing compared with the previous years. So with lower exports of the United States, that you make more oil availability to go to stocks. So I hope that for the coming weeks, we're going to have a build on inventories given this low trend of exports of crude oil. So that can improve the levels of stocks for the coming weeks, and that can bring some bearish fundamentals to the market. So that's something important to pay attention, okay? And also the second thing that we can see here in this slide, and here it's more easy to realize how exports of crude oil in the United States has been lower levels compared to 2023 and 2022. But also the refinery activity during this maintenance season, it's higher than compared with the previous years. Refineries are using more oil on their facilities. But over the last week, we have a decrease on the input oil of our refineries. So that also has increased the availability of crude oil go to the stocks. And that explains why in this last reading of the EIA United States, we saw one increase on stocks of crude oil, okay? So that's one of the important fundamentals that we have seen right now. But the most important thing for me to pay attention and to watch for the coming weeks is the level of exports of United States, because the capacity of production in the United States is still very elevated. It's above 30 million barrels per day. If the United States be less able to export crude oil, that means more crude oil will be available to go to the stocks. And if that happens, we can have one improvement on the stock levels of United States, commercial stock levels of United States, okay? Also here, and this is an interesting thing that I would like to call your attention. Gasoline levels for United States inventories, the motor gasoline inventories of United States this year, the build that usually happens now in the months of November, December, January, February, they are usually months where we have a build on gasoline stocks for the next driving season. This build is happening late this year. So as you can see, in 2023 started much before in a better level, but right now this year is starting late, and it's coming from a very low level of motor gasoline stocks. And why is that important? Because if something happened on refineries activity on January and February of this year, of the coming year, like frozen temperatures that have to shut down refineries, we can have a more bullish cracks for our BOB for the coming driving season. Because demand for gasoline is still elevated, is still fine. When I have the implied demand over the previous years, month over month, it's flat. When you compare week over week, it's just 1% below. And it's important to say that right now demand for gasoline it's decreasing because we are closer to the winter, so cold temperatures reduce the mobility in the country. But if in the coming driving season, the next driving season, inventories don't build fast enough, we can have a more bullish environment for cracks and for our BOB. Okay, so that's something important to pay attention when we look to get motor gasoline stocks. Also, when we look for heating oil, the situation is a little bit different. Stock levels is still, in my vision, a low level, still below the verge of 5 years. However, we are not seeing strong demand for middle distillates in the United States, not so far. When I look year over year, demand for middle distillates is 6% below. When I look month over 5% and week over week 2%. Decrease of percent of implied demand. And that's something interesting because right now it's the moment when demand starts to increase. And right now it's the moment that we should expect a more economic activity for manufacturing in the States in a better level, especially given the cut of interest rates. But so far that has not happened. And if the demand do not react strongly for the coming weeks, we're gonna have less support for heating oil prices. Different of 2023, we didn't have so much demand in 2023, but stock levels were in a much lower level. Right now, we have the prices of crude oil falling. We have no reaction on demand, and the level of inventories in heating oil are in a lower level, in a higher level compared to 2023. So this brings some bearish news for heating oil. Not necessarily the prices of heating oil fall. Again, seasonality, this is the moment where prices grow up because demand grow up on the spirit of the year. But I'm saying that maybe we're gonna have a so strong bullish reaction for heating oil, given these fundamentals of demand is still not very strong. Crude oil prices declined compared with the previous years, and the stock levels are in a high level compared with 2023 and 2022 as well. Okay. Now let's move for other products. Propane, it's a very interesting product. We have a very special report, a market detail report here in Hedgepoint. I advise you all go there to watch. We have statistics for exports in the United States, for port. We have which regions are importing more propane for the United States. And the first thing that I would say is that the price spreads of exports for Europe and the Far East markets was in a very high level in October and September, now have followed, especially because the price of crude oil has followed significantly. But exports of propane from the United States to other regions is still very elevated, still very strong. And that's important because if the United States is able to export more propane to other markets in Europe and for Asia, we have some support for propane price. Propane prices has a very strong correlation with crude oil prices. So when crude oil prices go fall, propane prices trend to fall as well. But we have support for exports from the United States, and that will bring some bullish environment for propane for the coming months, especially with the approach of the winter that demands more need for heating. So that it brings some support for propane prices right now. And exports in the United States is still very elevated, so that's a good sign for the bullish fundamentals of propane. Okay. Natural gas, a little bit different story. Production in the United States is still very elevated. Working gas in the ground storage is still in a very elevated level, higher than the levels that we saw in 2023. The weekly change in working gas in the ground is still following the trend of the past years. But the thing here is that any kind of supply issue that can happen on Europe, you have one impact on the benchmarks of natural gas, especially in the United States in the Henry Hub and on the Dutch TTF. We saw that happen recently in the past months when Norway was having issues to export natural gas to Europe. So we had a reaction on prices in TTF and also in Henry Hub. Right now, the escalating war between Ukraine and Russia, it's bringing also support for the natural gas prices. That's one of the reasons why you saw a very strong reaction to natural gas prices. But the general trend is still neutral when you look over these fundamentals, because storage is still in a very high level, and the weekly change is not has not pressured so far the stocks. The temperatures in the United States right now, it's showing some natural trend. We are not seeing strong demand for heat in the country. That's also one of the reasons we have to be more neutral for the perspective of natural gas over this season. But right now on this week, the geopolitical risks on Ukraine and Russia, it's bringing more bullish fundamentals, is bringing some premium to natural gas prices. But when you look all the fundamentals together put in the table, we still have a neutral environment for natural gas. Okay. Here again, exports of LNG is still fine, is still increasing in 2024, as you can see here. But demand, domestic demand in the United States is still, at least in the last week, below the levels that we saw in 2023 and 2024. And mostly for the months of end of October and November, the demand has been below the levels that we saw in 2023 and 2022. And given that you have more production, this more constrained demand is not bullish for natural gas. So that's something also important to be watched for the future. Now here we have the full consumption. It's growing in Europe, especially gasoline. Gasoline, it's almost 2 million barrels per day of consumption of gasoline. That's one important sign. It's a recovery economic activity in Europe. It's bringing the support. But demand for gas oil and diesel is still below the levels that we saw in 22 and 2021, just a little bit higher than levels that we saw in 2023. But it's important to say that Europe is cut interest rates, so economic activity can recover on the coming months, especially the manufacturing activity that can boost transportation and logistics of products and of goods and products in the continent, so we can have a better environment for consumption of gasoil and diesel for the coming months, especially on this winter. So that's something important to pay attention. But right now, looking at the data, is still below levels that we saw in the past 2 years, and that's one of the reasons why heating oil or LGO has not appreciated so significantly this year. Okay. Now let's move into a different region. Let's talk about China. China is a very important country when we are talking about oil consumption. I was mentioned the low imports of the country is one of the reasons we have been more bearish. Not us, but the market has been more bearish about crude oil. And it's important to mention that the stimulus package that China has implemented on the economy, it's important. That should bring some support for demand in the country, but not necessarily this stimulus will represent higher consumption for foods. Most of the packages, of this stimulus package, they are focused to help the local government's debt. They are focused to help to bring support for financial institutions. So they are much more focused to generate some balance on the financial side of local governments and institutions of the country that not necessarily mean more domestic demand. Apparently, all these stimulus that China is bringing to the economy, they are not focused to stimulate more demand in the country. And that is one of the reasons why maybe these stimulus packages, they are not to represent higher consumption for foods. Also, at the same time, you have a very strong ongoing energy transition in the country that also is reducing demand for gasoline or reducing demand for gas oil. So that's important things to pay attention. And when we look at the refineries utilization for independent refineries, the teapots of China, they are in a very low level because of a very low margins, and that is bringing also this more bearish sentiment for energy commodities coming from China. Okay. Here we in the right we have the consumption for gasoline and gas oil, diesel, and the apparent total demand is still very flat. Gasoline has been very flat. Diesel, gas oil has dropped significantly compared to 2023. So China is showing this more bearish perspective when you think about crude oil demand. Okay. Now let's talk about OPEC. OPEC, it's important. We know that decisions of OPEC has important impact on the market. Now in December, you decided if they will increase production in January or if they will late this increase of production. I believe, my opinion is that they will once again move the decision to increase. They will move the measure of increased production for another year. Prices right now are not bringing incentives to them to boost production. But the thing is, even if they decided not to increase production right now, the low compliance level of OPEC members is bringing some bearish sentiment that sooner or later a market share war could start inside the organization. Especially for Saudi Arabia. Saudi Arabia has been the most important player to defend prices so far from the group. But other nations like Iraq, UEA has increased their production, their exports most of the year, especially Iraq. Most of the year has increased their exports. UAE has increased their production and exports of crude oil as well. And that's somehow limiting the gains that they could have been having from this policy, cut production policy of OPEC. And that is something that is increasing the fear of the market that Saudi Arabia sooner or later can increase their production and exports as well to have a trade war against not just OPEC countries, nations, but other countries as well as Brazil, Guyana, United States, Canada, that has also increased their production. So that is one of the risks that the market it's pay attention. Again, I believe that the EU moved the decision to increase production for another year for 2025, but it's increasing the risks that a market share trade-off could happen between those countries, and that's something important to pay attention that can bring prices to a lower level. Okay. And for last but not least, on this section, Russia, it's also one nation that it's bringing some concerns. First thing, the escalation war between Ukraine and Russia could have two effects on the energy market. The first, that is the bullish effect, somehow Russia can be have more difficult to export crude oil production. And if they have a more difficult to export crude oil production, especially in the Black Sea, we can have a bullish fundamental of the market because supply will be lower into the world. So that is bullish for crude oil prices. That's something that could happen on this escalation war. The second thing, it's more bearish for the market. That is the focus of the attacks of Ukraine could be on the refineries of Russia, and focus on the refineries. Probably more availability of crude oil, more crude oil be available for exports in Russia, and that would be bearish for prices because if Russia try to compensate the low revenues that they are getting for refined products with more exports of crude oil, so that means that the world will have more supply of crude oil, and that would be very bearish for crude oil prices. So that's something important to pay attention. Right now, just the geopolitical risk premiums is coming to the market. It's bringing support for energy commodities. But depending how this escalated war happens, we can have a more bullish perspective for crude oil or less bullish perspective for crude oil. So that's something important to pay attention. Okay. And now, the last but not least, let's talk about the biofuels market. I'll be very quickly here, then I can go to the questions. First thing to notice is that the crude oil and soybean and palm oil, the oil, vegetable oils, are having a very strong correlation in the past years, basically because we have a more alternative fuels consumption in the world, like ethanol, like biodiesel, renewable diesel. But some different fundamentals are happening right now for soybean oil and for palm oil. Let's start by the soybean oil. The picture of Donald Trump, it's bringing some fear of the market that less exports of soybean of the United States is going to China. So that means more availability of soybeans in the country. That means if more availability of soybeans oil in the United States, you decrease prices. So we have seen over the past weeks, in the past week, some decrease on price of soybean oils, and that is affecting the RIN market of the United States because with lower costs of input for biodiesel and renewable diesel refineries, that means less a lower value for RINs credits as well. Palm oil, actually, it's happened something quite the opposite. Price of palm oil has increased significantly over the last weeks and the last month, especially because Malaysia, Philippines, Indonesia, they are having production issues, so they are decreasing the exports, the availability of exports of the country, so that's bringing support for their palm oil. And also they probably in the next year increase the blending of palm oil to biofuels, and that is bringing some strong support bullish environment for palm oil, and that's why the palm oil has increased significantly over the past month. Okay. And here, as you can see, I was mentioning about this, the BOHO spread has decreased significantly, especially because of the decreased price of the bean oil. And you can see here that when the cost of the bean oil is decreasing, but the price of heating oil, it's been stable, that's probably going to reflect a lower cost of RINs credit for United States. So lower values for D4, D6, that renewable diesel and biofuel and biodiesel and renewable diesel in the United States. So we are having this more bearish environment also for fuel market indicators for United States, especially the BOHO and the bean oil for United States. Okay. So basically, quickly resume about everything that we were talking. The energy complex remains in a challenging environment with lower than expected demand. Risky premiums will offset some of the bearish sentiment. However, no permanent damage to Russian energy infrastructure may dissipate in the coming months. On the macro front, the perception of lingering high interest rates could support the dollar, which could mean an important risk for demand for energy commodities. So basically, for the bullish fundamentals, we have the ongoing geopolitical tensions, the seasonal demand for heating that should benefit heating oil, propane, and LNG, natural gas, and stocks of liquids fuels in the United States still in historically low levels. So this is the bullish fundamentals that we're having right now on the energy market. For the bearish side, we still have the weak economic fundamentals in China and the slowdown in global demand growth. That is the revisions, the revisions that we are having, especially for OPEC right now in this last quarter of the year. Okay.